YouTube channel. Yeah, on our YouTube channel, our webinar will be uploaded from today. So just take the chance and be a follower on our YouTube channel. Good. Before we start with our topic, with our interesting topic, yeah, we have to show at first the risk disclaimer. Yeah, so we don't take any liabilities for orders, offers, market analysis, trading, everything. Yeah, so you're responsible for your own decisions. Yeah. Yeah, today we have got money management, protect your capital. This is a premium site, I would say. So this is the first time that we present the topic here from our course, money management, protect your capital. I think the course is free to enroll.
I think it's a tiny amount to pay, so I think $5 or so. Not 100% sure, but let me check.
The chat screen. Yeah, we didn't ask, so everyone can hear us, I hope.
Yeah, please give us a little feedback, and we can sure that you can hear us. And I have to turn off Discord because Matthias K is annoying. Hi, Matthias K.
He's stalking you, huh? Okay, good.
And the course is for free. And I can give you the link, or you already have done it? No.
No, unfortunately.
I do it. So it's a free course. And I think actually it is worth at least $20. So take it.
Good. So the contents what we're going through today is only from the course is the money management at all. So the general meaning. The second one is the risk reward ratio. What is it exactly, or the definition, and stop loss and profit target. Yeah, this is only a small part of the course. Just click on the link, what we pasted here in the chat screen, and then you will get the access to the whole course, which is free for everyone. So the general meaning, money management is a concept that protects the trading capital from losing trades, and it is the most important skill for trading. So today we will demonstrate the importance of applying prudent risk management to avoid large losses that can lead to you losing your entire trading account. Money management at all is very, very important in every trading at all. So money management preserves your trading capital. Money management, also called risk management, is a core concept that you should start with immediately when you begin to learn, and it should be the very core focus throughout your trading career. It will allow you to deal with performance downturns, and it will preserve your trading account during these times, enabling you to carry on trading. The core principle of money management is that you should only ever risk a very small portion of the money that you have to trade. So that means, sorry, many professional traders.
Could you switch back a slide, please?
Yes, of course I will do.
Because I want to ask all our audience participants, what do you think? What is a good thing to risk per trade to have a good money management? Maybe you have seen it already in the next slide, but maybe you have some ideas. What do you think? What is good? 5%, 10%, 1%, 6%? What do you think?
Just type it on the chat screen. Don't be shy.
Don't be shy. Exactly. Don't be shy, guys. You can only learn. No dumb questions or dumb posts are. So you can write everything. Okay, nobody wants to do it then.
Okay, then switch to the next screen, yeah?
And continue.
Good. Many professional traders do not advocate risking any more than 1 to 2% of an account on a single trade. Limiting your risk per trade to a maximum of 1 to 2% of your whole account greatly reduces the effect of losing streaks, as you will preserve the majority of your trading account. Risking only 1% on each trade means you can lose 20 trades in a row and still retain over 80% of your starting capital. If you were to risk 5% per trade, after 20 losing trades, there would be less than 40% of your original starting capital left. So the next screen shows the table. How can it look like? So the table shows you the effect of only risking 1% or less on each trade against risking 5%. After losing 20 trades, the account is reduced to 16,523 after risking only 1% on each trade. Risking 5%, the account balance is reduced to 7,547. After 20 trades, by risking 5% on each trade, the trader now has to make over 100% of the account just to get back to the original starting capital.
Amazing
See,
and impressive. So,
yes.
well, if you see it a 5% per trade and then you lose 15 trades in a row, then you need to double up your money or your trading account just to become break even.
Hmm.
It's amazing.
Simply by adhering to risk management, an account can survive longer drawdowns periods and still be able to trade. So there you can see the difference between 1 and 5%, yeah, if you're taking the risk on that side. Yeah, good. The next one is the risk reward ratio. Ensure that you gain more than you lose. The risk to reward ratio is how much capital a trader is willing to potential reward on the trade. You can use either monetary value or pip value when calculating the risk to reward. For example, if you are risking $1 to potentially make $2, the reward is divided by the risk, and so the risk to reward ratio is 1 to 2. If you are risking 30 pips on a trade and have a 300 pip profit target, the risk to reward ratio is 1 to 10.
Nice one.
A nice one, yes, correct. We will show this here on a screen or just on a chart model. When looking to take a trade, you should always make sure that your potential reward is larger than your potential loss, of course. The following chart shows you a real example of how this may look. The chart shows shows the stop loss shows as 1, it's the red line. The entry shown as 2 is the blue line, and the profit target shown as 3 is the green line. The distance between the stop loss and entry shown as 4 is 40.4 pips away. The distance between the entry and the profit target shown as 5 is 88 pips away. This means that the risk to reward is over 1 to 2 for this trade. Yeah, but unfortunately, over 70 or 80%, this is my number from the past, doesn't make this.
Yeah, I
Yeah,
think it's maybe quite more than this. So a lot of the people don't have the patience and the discipline yeah, to take all the losses without going crazy. So they doing crazy things like double the position size, risk more than 1 or 2%, or they do revenge trading. It's called so, and this is a dangerous thing.
yeah, absolute. So there we come to the last point of the content today. Know where your stop loss and profit target is before you trade. Anytime you consider entering into a trade, you should only have predetermined where your entry will be. You should also have predetermined where your stop loss will be. Once you know where your stop loss and entry point is, you can calculate the risk and potential profit on the trade. As a general rule of thumb, you should aim for a risk-reward ratio of 1 to 2 or better. If you maintain a risk-to-reward ratio of 1 to 2, then you only need 1/3 of your trades to win to remain break-even. The risk-reward ratio is closely connected to the percentage of your trades that end up winning. The risk-reward ratio itself does not automatically mean success. Even a risk-reward ratio of 1 to 4 does not help you if less than 20% of your trades end with a profit. So the risk-reward ratio has to be seen as an aspect of an overall trading strategy, and not in isolation.
So if you putting all the puzzle things together, then you can calculate the expected value, and this means you multiply the losses times the percentage probability and do the same with the winnings, and then you have the expected value, and the expected value has to be positive anyways. And if it's not positive, then you shouldn't trade this strategy. But this is maybe a topic for another interesting webinar.
Yes, why not? Yeah. And last, a great way to improve your effective risk-reward ratio is using trading stops, as they will make sure that in many trades that end up losing, you are losing less than the amount originally set for your stop loss. So this is my kind of strategy, for example. I generally, this is my personal point of view, don't work, for example, with profit targets. I work generally with trading stops.
Yeah, this is in general a good idea if you have a trend following strategy.
Yes, correct. But by the end, You're saying the numbers are more worse than 80%. Yeah, more than 80%, they don't have the discipline to hold the risk reward
Mhm.
ratio and to hold the stop levels and the dis yeah, to hold these rules by the portfolio management or
Yeah,
protecting money management. Sorry, money management at all.
correct. Yeah.
Someone says or saying you have to manage your risk. If you manage your risk, you will become successful in trading because it's calling risk management and not profit management.
Yeah, it's all about risk
Yeah,
management. I agree.
everything is all about risk management. Correct. So we came to the end of the webinar. If you have got further questions, you can contact us anytime on support@tradimo.com. Yeah. You have got also the chance for the next 1 or 2 minutes to type your questions also on the chat screen. This webinar is recorded, so it will be uploaded as soon as possible on our YouTube channel, so you can take the chance and can watch it anytime. Sorry. And you can click on the link to see the whole course here to, yeah, protect your money. Money management. All about is risk management.
Unfortunately, I don't see anybody is typing, so this means we really comes to the end. And
Okay.
I wish all of you a nice evening, a nice Christmas time. So next week it is Christmas, so we don't have any webinars. So we will see each other in the next year.
Correct.
Okay. Cool.
Correct. And then also with new topics.
New topics. Exactly.
Yeah. Okay, very good. Thanks, Matthias, and
Yeah,
wish
you're
you also a
welcome.
nice evening. Thank you.
Nice
Bye.
evening. Bye, guys.